Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on July 25th, 2022, and we certainly have a week ahead of us, which I'll get into specifics in a moment. But for that reason, Emily and I decided we're going to push trading back from tomorrow to Thursday. Thursday is a day after the Fed announces what it's going to do, and a day, for the most part, after a whole bunch of earnings announcements that come out, which I'll review in a couple of minutes. In today's session here, I want to do something I haven't done in quite a while. I'm really going to be reviewing what we did last week because there's a lot of learning to be had from looking at the very quickly open and closed trade that we did, and to emphasize the importance of rates of return. You know, we all focus on cash here, but the rates of return, especially when you're looking at a week coming up like this week, when the rates of return are telling you to close because you're well past your target, you're well past your goal, it's time to close. So, and this is reflected in the results of last week. Two positions, two closes, and we took a big hit on Lyft. No getting around it. Lyft was put on after a very good earnings announcement, and the street was very, very happy with their margins, with the growing revenue, with the comments by management. Since then, with consumer discretionary spending falling, that sector up until last week falling down very hard. I had to take a hard look at Lyft about what were the possibilities that we would be able to exit this trade close to break even. And the answer was it was going to take a way too long period of time, not just from a technical point of view, but they'd have to have some spectacular blowout earnings announcement, which just isn't in the cards. And the other thing that told me that the sector itself is down is that Uber's had a lot of problems in the headlines because of the Washington Post Uber investigation, what was going on in Europe and so forth and so on. And money did not shift from Uber to Lyft in the market. It's just the whole sector took a hit. So it was time to take a loss and time to move on. And you can see with Roku and the KRE, we closed with smaller absolute returns than we normally do. Typically the target, we want 0.5%. But these were very in and out trades. They were very, very fast. They're a little out of the norm. But the annualized rates of return, which is the ultimate dictator of opening and closing, were very, very high. So in addition to that, of course, we rolled and generated a whole bunch of cash from rolling positions. And we're now, as you may have noticed, with the core positions, the four core positions of Pfizer, General Motors, Marvel, and Citigroup, we may be rolling them out 2 weeks to generate cash. We're trying to avoid trying to have 7 or 8 or 9 open positions expiring on the same Friday, especially the Friday of this week. And so last week to goal, from an annualized point of view, we were down, but I think the position management was on target because of what was going on in the world and because the opportunities presented by the trades we had just put on. And so forth and so on. So the new trades generated a total return of that sort. What is it about this week? This week is a Fed meeting. A 0.75% rate increase is baked into the bond market, as is one for September. And the question is, what will the minutes be like? A lot of people said the Fed might 2 or 3 weeks ago be dropping hints that they might go to a point. I don't see that happening in the bond market. Does not see that happening. The underlying inflation gauge, the UIG, which is what the Fed moves on, actually went down 1/10 of a point in the last set of data that came out. And I think that solidified all the inflation watchers in the bond market going, nah, it's going to be 0.75%. And I had an interesting conversation last night at dinner with someone who is very familiar with one half of politics, but not with the politics of the economy. And we were talking, he says, do you think a recession is coming? And what about inflation? And the conclusion that I offered to him as an opinion was the Fed had to act because their big concern, the three things they can't control are housing inflation, short term, they can control it long term, food inflation and gasoline inflation, they can't do anything about those two. But they needed credibility. They needed to show they were doing something. But the fourth thing, which is the most important thing, is they began to look at consumer sentiment surveys and that consumer concerns were becoming consumer expectations of future inflation. That's really something the Fed has to hit hard. So the Fed's going to continue to do this, is my point. As long as the minutes are even and not more hawkish and so forth and so on, I think that it'll be somewhere between an event that lasts a day or two or a nothing burger. The other thing is people, if you look at earnings announcements, so far 21% of the S&P 500 has announced earnings, and they're on target. 70% have beaten expectations, which is the norm. And the bottom line is you can see the way the market moved last week. The concerns are about growth, less than inflation. Why? Because they're assuming the three-quarter of a point in July, and they're pretty much assuming three-quarter of a point in September. Next week, this week, excuse me, we have enormous number of enormous companies. That's Apple, Amazon, General Motors, Google, Facebook, which is now called Meta because they want people to forget that they're Facebook, McDonald's, Microsoft, Pfizer, among. There's also Qualcomm, and there's a whole bunch of other companies that are announcing. Boeing is announcing. And these could drive the market. And excuse me, and these are Apple's a real tech stock. Facebook and Google are marketing stocks. Amazon is a retail stock, and Pfizer's a real tech stock. They're all lumped together as tech. They're the growth drivers. They're the double-digit growers even during recession. Their comments, their forecasts, as well as some of the details of their earnings will be very important. Again, you put the two together, it's why we're trading on Thursday and not tomorrow. And stocks have been responding in a fairly rational way to both good and bad news. And that's very good news because that was not happening over, I'd say, the last 3 to 5 months. The stock market is now maybe sharply trading off certain companies because of bad news, but they're doing the right thing. It's bad news. And crypto is also lingering out there. I really need to start developing charts that parallel the rise in the price of Bitcoin or the fall in the price of Bitcoin and then movements in the bond and the stock market, and they're directly aligned. And so to that point, one of the things I could put out for August, it's not this week, is there will sometime in August be an administration task force coming out with recommendations concerning digital currency, which is different than crypto, and it may have an impact on crypto, which in turn may impact the market. So let's get back to how we traded and discuss the tactic, which is a silly put trade. It's a put with a strike price that is considerably out of the money. I stole the term many, many, many years ago from Art Cashin, the gentleman who walks the floor and speaks into the mic at CNBC, works for a brokerage house. He's been around, and if you're, well, I don't know if he's still with UBS, but when you're a UBS customer, his newsletters and his missives, which also included Wall Street history, were fabulous. And a silly put has a strike 10% or more lower than the share price. If expirations in 1 to 2 weeks, if it's longer than 1 to 2 weeks, it should be 15%. And there is a limited universe of tradable stocks, but we don't go away from fundamentals. We still work on fundamentals, and the charts are pretty much the same. We're not looking at the 2 and the 5 or the 3 and the 5. It's really the 10, the 30, and the 100-day bottoms that are very, very important. You want to get to that bottom and below if you can when you're looking at the strike to sell. And they have to be liquid. They have to be weeklies. And it's 1/3 of a percent, 0.35. It's a lower rate of return, but preferably more. You're trading off the distance from the share price for a lower rate of return. And the possible outcomes when you sell a silly put, you close early, which you will see we did. If you're hitting that goal of a 32% annualized return, you can roll up the strike. This is what I anticipated in the Roku trade, which we'll get to in a moment. You're going to buy back the original strike and sell a higher strike for the same expiration date. You're watching charts, you're looking at the movement of the stock and to see if it's moving in our favor. You're closing. If news breaks from a competitor that would affect them, or you're nearing a major event on the horizon, it doesn't have to be the next day, but the next week is the Fed and all these earnings. Or the mantra here, if things go against you and the fundamentals are the reason you pick the stock and it's great, you accept shares. And it rarely happens with a silly put, but it can. So with Roku, this is what we did, and you can see we were $11 out of the money. A huge difference. I think it's 18 or 19, 13% out of the money. Very, nice chunk of cash. And the potential rate of return was above a 0.5, even though I suggested 0.35, or was going to be 54% annualized. These are huge rates of return for a silly put, which sets up what happened. Plan A was to roll to a higher strike price. So we put it out on Tuesday. Maybe we roll it up in a day or two and we bring in more cash and boost the cash, boost the rates of return. Plan B was to close early. We chose Plan B on the same day. I can't remember. We probably did this maybe once last year and once the year before. Practically never do it out of 100 trades or more a year. But it was just staring us in the face. Gigantic annualized return. And I knew, because it was earlier in the week, that we could put out another trade by alert, which we did. So the bottom line is there was a tremendous positive logical rationale for doing this. So we redeployed the capital from that trade and we sold a put on Block, formerly known as Square. And we traded this 35 times in a row way back. And I'm very, 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 very familiar with the company. And we sold a silly put 18% out of the money, which to me, and you looked at the charts, it was more than a comfortable cushion given what was going on this week. So I'm not contradicting myself about trading after the Fed on Thursday. I'm not contradicting myself about what would happen if the Fed really hits the market, et cetera, et cetera. In part because Square loans money to people and it uses its float when people use Square Cash and so forth and so on. So if interest rates, if the view of the Fed announcement is more hawkish, Square could actually benefit. So there were two things going on, and it's the same plan. Plan A is to roll up, and Plan B is perhaps to close early. And this is what the trade looked like for those of you who are not in it. You could see how deeply out of the money we were, and 18%. And if you looked at the charts, it was a very comfortable place to be in terms of selling that strike. Because if you really took a really negative and cynical view of the chart, you would see 60, in my opinion, as a desperate support level. And that meant if you had to roll it or you had to take a small loss, you'd be in good shape. So it was a muted rate of return compared to Roku as a potential rate of return. But remember, Plan A, we can boost more cash, boost the rate of return. Plan B, we close early, we boost the rate of return. And in that vein, we also closed the KRE regional banking ETF. Now, regional banks do better when interest rates go up. And so I was less concerned about the impact of a Fed announcement unless something really untoward happened in the banking sector and all banks, the large money center banks and the regional banks went down. But again, the annualized rates of return were there. And so we gave up a bunch of cash, but with, again, the Fed out there just in case, and a 42% annualized return, it was just the combination of the Fed meeting and the combination of the annualized rates of return were just too good, to ignore. So two closed trades and one new opened trade, Block, because we had freed up capital. And I hope this kind of dynamic thinking gets into your brain, if that's a fair way to describe it. Is there's nothing wrong with selling something way out of the money with a more modest return if it expires worthless, knowing that you have a couple of choices. I'm going to avoid the cliche of a couple of options of either rolling up and generating more cash and higher rates of return, or closing early, redeploying your capital and having better rates of return. And they give you a lot of flexibility. They really do. And again, it starts with fundamentals, but they give you a lot of flexibility, especially as you near a major week, such as we're nearing. So speaking of which, trading this week, we're going to be nimble, we're going to be aggressive, and we're going to trade after the Fed announcement. We may roll positions that were in before the Fed announcement, not sure, it depends on the market. But we will definitely be nimble and aggressive. And if the market gives us clear direction, the only really big name, and it could pull the market, that's announcing after our trading session is the one that I think about is Apple, which has held up better than any other tech stock by far. It's only down 13% this year. So we could put on theoretically 3 positions. I'm not promising that, but it's possible. I'm certain that we would do 2. So we're not depriving ourselves of cash. We're just putting it on a little bit later. This is Michael Schulman. Thanks for listening.